So the candlestick pattern, a candlestick is a way of displaying information about an asset price movement. Candlesticks charts are one of the most popular components of technical analysis, enabling traders to interpret price information quickly and from just a few price bars. So the candle has a body, a wick, and a color. So the body represents the open to close range. The wick or shadow, which is sometimes called, represents the intraday high and low, as where the market moves to when after opening and retraces back into the body, and where it got to and retraces from before it closed. So those areas will be represented by a wick, and we have the color. So it could be, some people use green, blue, and white for bullish candles, and they use red, black, and maybe other colors for bearish candles. So, but generally you see white or green for bullish and black or red for bearish. So over time, individual candlesticks form patterns that traders can use to recognize major support and resistance level. There are a great many candlestick patterns that indicate an opportunity within a market. Some provide insight into the balance between buying and selling pressures, while others identify continuation patterns or market indecision. We'll look into that, we'll see all of them as they are. So before you start trading, it's important to familiarize yourself with the basics of candlesticks pattern and how they can inform your decision. So practicing reading candlesticks pattern, you must ensure that when you are using any candlestick pattern, it is important to remember that although they are great for quick prediction of trends, they should be used alongside other forms of technical indicators or analysis to confirm the overall trend. Don't just jump into trade because you see a candlestick pattern. There should be a combination of other indicators or price action before you take the trade with candlesticks pattern. So let's look at some of the bullish candlesticks pattern. The first one we have here is the hammer. So the hammer candlestick pattern is formed of a short body with a long lower wick, a short body with a long lower wick, and is usually found at the bottom of a downward trend. So when you see a short body candle with a long lower wick at the bottom of a trend, that is a hammer. So it shows that although there were selling pressures during, sorry about this. So it shows that although there were selling pressures during the day, ultimately a strong buying pressure drove the price back up. That is why you have that long lower wick. So the color of the body can vary. It could be green, it could be red. That means it could be a bullish candle or a bearish candle. So this is an example of a hammer. Look at it here. This is a bullish candle. This is a bearish candle. And as you can see it here, look at it. You can see this one is a bullish candle. So price was on a downtrend, and the whole of this candle was formerly red because the candle opened here and moved down to this level before the bullish pressure pushed it out back up into this level, got to this point and retraced back at the last the candle closed here. So as I explained, in a candle we have the body. This is the body, this is the open. Between the open and the close you have the body, and this is the wick. Market went back down to this level before retracing back up after opening here and closed here. That is why we now have this wick. So for a bearish candle, it will open on the top and close at the bottom. Bullish candle will open at the bottom and close on the top. So this is what we refer to as hammer. And here, this is hammer as well, but this one is a bearish candle. So it doesn't matter the color of the candle. As once you see this at the bottom, you can the combination with other indicators, you know when to enter the trade. So we also have the inverse hammer, which is just opposite the hammer, just the inverse. The wick is now above. The longer wick is now above. So this is it, as you can see. But it must be found at the bottom of the trend as well. So longer wick on top. So this is an example. Inverse inverted hammer. So the trend was going down and suddenly we got this. Then we have a bullish engulfing pattern. So the bullish engulfing pattern is formed of two candlesticks. So the first candle is a short red body that is completely engulfed by a larger green candle, a short bearish candle completely engulfed by a larger bullish candle. So though the second day opens lower than the first, the bullish market pushes the price up. So and this culminating in an obvious win for buyers for that day. So look at this. So we have a small bearish candle completely engulfed by a bullish candle. And this is it. This is how you see it on the chart. This red candle completely engulfed. So when you see this and if it forms on a support level, there's a good probability that market will push up. Then we also have the morning star. The morning star candlestick pattern is considered a sign of hope in a bleak market downtrend. It's a three-stick pattern. One short body candle between a long red and a long green candle. So traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. So it signals that the selling pressure of the first day is subsiding and a bull market is on the horizon. So there is no overlap. Let me show you an example. This is it. So as you can see, there is no overlap. There's no lapping at all between the two of them. There's a gap, small gap between them. So when you see this and this comes up and finally this on a support level, you now take a buy. This is an example of it, how it looks like in a chart. This is the morning star. So when you see this on a support level, on a support level, there's a bullish trend about to take place. Then we also have the hanging man. The hanging man is a bearish equivalent of a hammer. So we are not talking about bearish candlesticks now. So this is the opposite of a hammer. A hammer is found at the bottom of the trend, but a hanging man is found at the top of the trend. So the hanging man is a bearish equivalent of a hammer. It has the same shape, but forms at the end of an uptrend. That is just the difference. So this indicates that there was a significant sell-off during the day, but that buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. This is how it looks like. So it's a hammer formed at the top of a trend. So we call it a hanging man. This is how it looks like. This is what it is. But if this formed at the bottom is not a hammer, but this one we call it a hanging man because it found on the top. When you see this on the support level, there's a probability that market will go down. Then the next one we have is the shooting star, which is the opposite of a morning star. So the shooting star is the same shape as the inverted hammer. Okay, yeah, the inverted hammer that I showed to you. Inverted hammer that has a long upper wick. So usually the market will gap slightly higher or opening, slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground like this. This is the shooting star. You see it on a resistance zone or a resistance level. It could be green and it could be red. This is how it looks like on the chart. Sorry. So this is how it looks like on the chart. Shooting star. Then we also have the bearish engulfing, just opposite of the bullish engulfing. So it's an engulfing pattern which occurs at the end of an uptrend. So the first candle has a small green body that is engulfed by a subsequent long red candle. So it signifies a peak or slowdown of price movement and is a sign of impending market downturn. The lower the second candle goes, the more significant the trend is likely to be. This is it. So a small bullish candle completely covered or engulfed by a red candle. This is a bearish engulfing pattern. And if it happens on a resistance level, price would it tends to go down as it did here. So this is the small blue candle and bullish candle completely engulfed by the bearish candle. The body must be engulfed. The whole of the body must be engulfed by this bearish candle, and that is how it goes. So we also have the evening star, which is the opposite of the morning star. So it's a three candlestick pattern that is the equivalent of the bullish morning star. So it is formed on a short, it is formed of a short candle sandwiched between a long green candle and a large red candlestick. It indicates the reversal of an uptrend and is particularly strong when the third candlestick erases the gains of the first candle. This is an example of it. Look at it here. See the gap between them. This is a morning star, as we explained the initial time. Then this is the evening star. It appears on the top in between two long candles. So when you see this, there's high probability that market will begin to go to the downside. We also have a continuation candlestick pattern, and the only one I will talk about is just the Doji. So when a market's open and close um, are almost at the same price point, so the candlestick resembles a cross or plus sign, traders should look out for a short to non-existent body with wicks of varying length. This dodging pattern conveys a struggle between buyers and sellers and results in no net gain for each side. Alone, a doji is a neutral signal. So, but it can be found in reversal patterns such as the bullish morning star and bearish evening sign. And when you see it in between trend, it could give you a hope that that trend will continue. It's like this. So you either see it this way or like this. Like this is common, but like this is a gravestone, like this is long-legged, and like this is a dragonfly. So you either see it like this, like this, like this, or like this in the trend. Look at it here. After this, we now have the doji, and we saw a downtrend. Just this shows us that price is the trend is reversing, and this came up. So this can give you a hope that the reversal will continue, and that was how it went. So I'll just go through the charts to see some of these patterns, if we can see anyone, just to identify them. So we have we have this. This was supposed to be like the evening star, but it's not clear there. But anyone I see here, I will just tell us. So this is a bearish engulfing pattern. Bearish engulfing pattern we have here. Then this is a hammer. This is a doji. Then there's one other candlesticks. I will explain this one on another class that will be part of the concept. So this is a hammer. There's a name for this. This is the railroad track. I've talked about it before, but we will talk about it in one of the classes. Railroad track. Candles of the same size when they happen at either at the support or resistance level. So just go through the video again and check your charts and practice this candlesticks pattern. Just go through your chart and begin to look for them and see how they react on a resistance and a support level. So the next class will be on, since we've treated both bullish and bearish candlesticks pattern, the next training is going to be on support and resistance. So that is what we'll be talking about. Please do well to like this video, subscribe to this channel, then you can also share the video as well. So thank you for joining in this training. I hope it's going to add something to your knowledge, and we'll meet on the next class. So by tomorrow we'll go for the next training, and by the end of this week we are going to release the new strategy that we are preparing ourselves for. So as I said before, all these things are, look at a very long hammer, are very important because we're going to apply them in the strategy that we're going to reveal. So you can also click on the notification bell so that you can be notified when we upload new videos. So thank you for joining on this training, and God bless you.